For the 2026 fiscal year, Reliance Industries reported double-digit growth across its core financials, logging a 10% increase in revenue and a 13.5% rise in EBITDA. Those full-year numbers suggest stability. However, they mask an extreme destabilization in the global energy market that struck during the fourth quarter. This data shows the divergence. While RIL's revenue curve tracked smoothly, the energy sector faced sudden volatility. Dubai crude reached $168 a barrel, liquid natural gas hit $27 per MMBTU, and ocean freight spiked 15 times above normal. For a conglomerate historically dependent on energy processing, this level of supply chain disruption should have led to a significant earnings collapse. The EBITDA mix reveals why that collapse never happened. Over 55% of earnings now come from domestic consumer businesses like Jio and retail, a structural shift that shields the company from legacy energy supply chain volatility. To understand the pressure on the energy division, we must look at the Q4 logistics failure. A bottleneck at the Strait of Hormuz cut off 10 million barrels of oil daily and blocked 3.8 million tons of monthly naphtha flow. This starved East Asian industrial hubs. Without this naphtha, regional ethylene operating rates dropped from 80 to 60%. Simultaneously, Qatar Energy declared a sudden force majeure on its LNG operations. This removed 70% of their capacity, further tightening global supply and sending natural gas prices upward. For any import-dependent refinery, this combination of supply starvation and skyrocketing insurance premiums creates a scenario where operating margins typically vanish. Reliance's oil-to-chemicals division responded by maintaining a near-capacity throughput of 19.5 million metric tons, keeping the Jamnagar complex running despite the breakdown of standard supply lines. This throughput is the result of engineering flexibility. The refinery is designed to process over 200 different grades of crude oil. When Middle Eastern volumes were cut off, RIL used this flexibility to pivot its sourcing. They secured heavy and sour crudes from Venezuela, Russia, Brazil, and Mexico to keep the units fed. Sourcing these alternative barrels came with extreme premiums, sometimes $30 over benchmark. Combined with the domestic special additional excise duty, these costs limited the actual profit captured, despite high global fuel prices. These operational adjustments stabilized the division and prevented a collapse, but legacy energy processing was not the source of the quarter's growth. That required the consumer ecosystem. Jio Platforms provided the digital offset. For the year, its EBITDA reached 76,255 crores, a nearly 19% increase. This chart shows the internal leverage of the business. Even without tariff increases, the average revenue per user rose to 214 rupees, while the EBITDA margin expanded to 56.2%. This growth is organic, driven by 268 million users migrating to 5G and per capita data consumption hitting 42.3 gigabytes per month. The fixed broadband rollout added another layer of scale. Jio now reaches 27 million homes, with 75% of recent additions powered by AirFiber and non-line-of-sight wireless technology. This represents pure operating leverage. By increasing data consumption over a fixed infrastructure base, Jio converts incremental revenue into margin expansion with minimal additional cost. Reliance Retail provides the physical counterpart to the digital network. It generated 98,000 crores in quarterly revenue through a footprint of 20,000 stores. These locations serve a dual purpose. They are walk-in stores that also function as delivery nodes for a hyperlocal quick commerce network. While retail margins sat at 7.9%, the company is prioritizing volume. Capital is being deployed to scale quick commerce, which saw orders grow 300% year over year. JioStar then captures this audience digitally. It reached 550 million monthly active users and set a global record with 72.5 million concurrent streams during the T20 World Cup. RIL links passive viewership directly to active commerce. By integrating voice search and food ordering into live streams, they capture spend far beyond traditional advertising. Looking at the last 5 years, it's clear that the resilience shown in Q4 is the result of a long-term capital allocation strategy. This chart tracks the scaling of the 3 core pillars. Since 2021, the oil-to-chemicals division has grown less than 2 times, while digital has scaled more than 2 times, and retail has scaled 2.5 times. That flat overall EBITDA in Q4 confirms the diversification shield works as engineered, distributing the load even when the energy segment takes a significant hit. Reliance Industries is now a domestic consumption engine, powered by the modernization of India's retail and digital infrastructure, rather than a proxy for global petrochemical cycles.